Ever sat at your charts for hours watching the market do absolutely nothing, and the second you walk away, price takes off without you? This isn't bad luck, this is bad timing, because the market is designed to move with intent only in specific window of opportunity. If you don't know this, you are literally gambling in dead hours of your trading session. In this video, I'm going to be sharing with you specific hours of the day that you should be coming into the market where you can likely expect the big moves, expect premium and discount price, so you can literally overcome over trading and also create consistency in your strategy. Stick to the very end because I will share the exact framework that I used with the time of day to become a consistently profitable trader. Let's waste no time. Let's jump straight into it. Every trading session has what's called a kill zone, a 3-hour window where liquidity enters the market. Think of it as the heartbeat of that session. These are the times where the banks and institutions are active. That means orders are flowing, liquidity is injecting, and price actually has the fuel to move. These are the times that you as a trader want to be in the market. So when it comes to the kill zones, you have the Asian kill zone, you have the London kill zone, and the New York kill zone. These are the times of the day of each particular session where you are likely going to see liquidity come into the market. We know that the market is open 24/7, 5 days a week. That doesn't mean that the market runs 24/7, right? There are going to be periods in time where you're likely going to have a high probability setup, a low risk opportunity to get involved in a trade with zero drawdown. And this is what the kill zones are for. The Asian kill zone is from 7 to 10 p.m. Eastern time. If you're trading the Asian session, these are the times where you want to start to look for a possible entry opportunity. 3 hours during that session, these are the times where you're likely going to see the biggest move take place or form to take place. Over here, we have the London kill zone, 2 a.m. to about 5 a.m. Eastern time, right? This is also where you can likely expect, if you're a London trader, liquidity to come into the market and price to actually start to move. The New York session is my favorite session. That's what I trade. It also overlaps the London session, but you also have that rollover period from one session to another that takes place in between, whether it's just that 1 hour or 2 hours where the market is kind of resetting for the next session, right? And that rollover period a lot of the time is between like 7:30, right? 6 to 7, pretty much 6 to 8, where nothing is taking place. The market is resetting, setting up for the kill zone, New York session, New York open. And that's where we have the 8 a.m. to about 11 a.m. Eastern, which is when I come into the market and I'm looking to get premium price. I'm looking for a setup and I'm looking to get involved in a trade where the institutions are going to come in with the volume and the liquidity that I need in order to actually make money. So if you start to focus on the kill zones, you're going to start to see you don't need to spend a lot of time in the market. And after this kill zone is over, oftentimes what happens is the market starts to get choppy, right? Or it just slows down, it just dies for the day, or there's some sort of reversal that takes place. Goal of trading kill zones isn't just to get high probability trade setups, but it's to position yourself correctly at premium or discount pricing. You don't want to be the trader chasing breakouts at the middle of the day or buying at the high after a move has already happened. When you align yourself and you're trading with price and time, you catch the move right when they begin, not when they end. In the market, we have something called time plus price equation. That is premium / discount price. Right? This is the time where you're likely going to come into the market and you could get a low risk entry, an opportunity to get involved in a setup that has already been forming, and paired with the kill zone, which brings in liquidity from the institutional side, right? Or brings in the liquidity from that particular session, right? From the institutional side, it flows and it creates a high probability trade setup. You don't need to trade for a long period of time. If you understand this concept, right, and this equation, you start to realize after a certain time of the day, there's really no need for you to still be trying to place trades. And trying to trade outside these kill zones is just poor on your end. You know that If I'm coming into the market and I'm trying to trade at 12 or 1 p.m. during the day, there's something off psychologically. I'm either trying to make up for my previous losses or I am just losing it, because this is not just theory. This is facts, right? You come into the market. This is the time where you want to position yourself for the best possible outcome, high probability trade. And in order to do so, you have to come in during the kill zone and then factor in premium price, right? Discount price, take that for your setup. And that's pretty much it, right? You want to trade when liquidity is present, not when the market is sleeping. So let's take a look at this example right here. We have all 3 sessions laid out. We have the Asian kill zone at 7 p.m. till 10 p.m. Eastern time. In the Asian session, we can expect liquidity to come to the market, and we can also expect what we call premium price to come into the market. This is important because it's not just about liquidity. It's not just about premium price. It's also the daily time frame and weekly time frame as well. Because if buyers are in control on those time frame, we want to stick with that because those are the time frame that the institutions are actually paying close attention to. They're not paying close attention so much to the lower time frame because the higher time frame governs this lower time frame. So if you're coming in and you're paying attention to the individual session time, which you're able to have a better scope when you scale down to a lower time frame, you also want to make sure that you are in line with where price is on the higher time frame. So if we're in a buyer's market, the goal is still to look for buys. And right here, that is going to give you that premium opportunity, premium/discount price for you to be a buyer right at about 7 p.m. Eastern. If you came in, whether you took maybe this buy setup right here. So this was about, we could say over, let's see, this was, 6, right? The market was still setting up and pushing lower. If you had bought right here, you probably would have been dealing with some drawdown because you're going through a rollover period. The New York session just closed. The market is still setting up, and then it's set up, and then you got that opportunity to take price to the upside. And after this move, this was 170 pip push up. After that has happened, of course, the market is not just going to move up forever. You had a bit more of a pullback, a nice little reset, and the market started to build back some steam again as we start to come back into the London session, right? So this is the London session kill zone from 2 a.m. to about 5 a.m. Now, I want you to look specifically, right, what happens here. An hour after the market opened, right, after the London session, this is 3 a.m. Eastern time. You see that liquidity really starts to build. This gives you that discount/premium price that we talked about. Same as the Asian session, you get that opportunity. Let's say you go be a buyer, you put your trade in, and just shortly after that at about 4:15, right, 4:30, boom, right, the market takes off. This is 5. You see that, right? So this is about 5:15. Shortly after that, the market starts to move sideways, right? This is the power of understanding the kill zone. And then you go through that rollover period where the market is resetting and just setting up for the New York session. And right here, usually come to the New York session about 7, just to 7:30 to analyze as we prep for a possible entry at about 8, and boom. Right? So we start to see here, we're paying attention to it, and the market pushes up, stays in this consolidation range the whole time. What we have here is we start to see more sellers come into the market. And after that, there was nothing happening for the remainder of the session. It was pretty much just like, yeah, we had a little bit of a push further down as well. But overall, we had the market just kind of playing back and forth until, very much later in the day, we had this push. This was driven by news. But overall, this is the power of the kill zone. Understanding these times can give you a great deal of advantage in the market. This is where a lot of traders go wrong. They think that the market should give them a setup 24/7. But outside of these kill zones, the market is either consolidating or stop hunting. When you come into the market and you're trading during dead hours, you're literally practicing how to lose. But when you align with the kill zone, you filter out the noise. When it comes to the kill zones, these are some of the things that you should avoid, and these are the things that you should do. Starting off here, don't trade. You don't want to be trading random breakouts outside kill zones. You don't want to be even taking trades that are showing up outside of the kill zones in terms of your strategy setup. Every single strategy that you have, whether it's an accumulation and distribution strategy, whether it's a break and retest, will have a time where it is likely going to be very, very effective. And when you do trade them outside of the kill zone, it lowers the high probability of that trade, the possibility of it. It doesn't necessarily mean you may not win that trade. You could, right? You could get lucky, but oftentimes what happens is it just doesn't work out, or you go into a longer drawdown than you would like. Now, late entry after distribution or expansion. What this simply means is sometimes you come into the market. If you fail to come into the market at a kill zone, or you've slightly missed that kill zone, what you're going to see is the move for the day has already happened. So if you're trading the New York session, if you're coming or looking at the market sometimes by 10 a.m., you might have already missed a big chunk of the movement for that day. And then imagine coming into the market at about 12 p.m. and trying to take a trade. The odds are your opportunity for the day is gone. Midday chop, that's usually just sideways market after the kill zone is already passed. So you definitely want to avoid this. Now, when it comes to do trade, you want to trade in line with the higher time frame. That's always important. Even though you're still factoring the kill zones as well, you are looking to come into the market and get in premium and discount entries, right? During the kill zone, when you do come in, you're not just looking to take a trade because the market is there. You're still waiting for optimal entry, what we call premium price, because if the market is already pushed up, you want the market to come give you that retest. So if the London session, you saw a huge push in the upside, right? The New York session, you might want to wait for some sort of pullback, or maybe some sort of, consolidation, accumulation, and break and retest of that zone. Now here, which is what I just talked about, clear, accumulation, and distribution. Take your setups, right, during the kill zone. Take any pretty much clean, clear strategy setups that you do have during your time in that kill zone. So from 8 a.m. to about 11 is my kill zone. When the market presents me with an opportunity that I like, that fits, and gives me premium price, fits with the higher time frame, I am executing. Accumulation and distribution is just one example of that. So here's how I use kill zone in my own trading. Now, I live in the Eastern time zone, and I'm a big believer in maintaining consistency in your process. If you're going to pick a session that you're going to trade consistently, try to stick to that session and try not to trade multiple different kill zones. I do have the Asian session, which I will execute from time to time, a particular swing trade, which I will be sharing with you guys at a later point. But yes, the Asian session is a session most of the time I don't trade. The New York session is my primary session. The Asian session is usually just, setting up, potentially getting ready for that big push. Now, one of the tools that you can definitely use as you start to get comfortable with identifying the kill zones, right? Using the trading session. What it pretty much does is allows you to get the highs and the lows of each individual session, the highest point and the lowest point. And what you're going to notice as I plot this on right here, it has the Asian range, which spans the time that I have shared with you previously. So this is from 7 p.m. Eastern time till about, I believe, 10 p.m. Eastern time. This is the kill zone. This is the time that you're likely going to see a lot of the movement taking place in the market, a lot of liquidity flowing in. We had in this Asian session, we had price push up to the upside, and then we had a little bit of a liquidity sweep, setting up for more buyers to come into the market. And then what you see here is right as we start to get into the London session and London kill zone, we start to see the market pull back, setting up for premium price. About 2:40 going into the 3 a.m., the London session starts to set up and presents traders with this premium opportunity to now get involved in a possible buy trade. You have this opportunity here. If you're a London trader, you can look at this and you can say, okay, you know what? This is a great opportunity for you to get involved in. And let's say you take your trade, boom, based on the higher time frame as well. Let's take a look right here. Boom, right? You see the market changing, market structure, creating a little bit of a high here, high or low, and then making a push to the upside. You can either get in with this candle, set your take profit either at a area of interest, right? This would be about 80 pips worth of movement that took place. And it wasn't really a ton, right? Here you can set your stop loss at about 30-ish pips. The market literally ran with zero drawdown and pretty much gave just, right there. If you targeted this high, boom, right? So this would have been a pretty easy trade, right? You would have risked about 30-ish pips to make 80 pips, and that would have happened in a span of how many candlestick right there in about 40 minutes, right? Because you came into the market at the right time. And right after that objective was completed, a couple of minutes later, I believe, an hour later, the session pretty much, the kill zone ended. What did you see? Right? You saw a little bit of stalling. The market started to pull back. This is the rollover period where now it's setting up for premium price for the New York trader. But now as we come into the New York session, we have our London high. This would be the London low, right? That formed at about 2 a.m. And now this would be, let's just call this, we would call this the London, since price took out the London high and then did the rollover, we would probably focus more solely on the London low. So now what this simply means, so as long as price is above the London low, there's a good chance that we could see more buyers come into the market. So based off of this here, at 7, at 8, we come into the market, and what we're seeing here is the market is setting up, continuing to push the downside. We're paying close attention, and then we get that big surge in liquidity, which comes in at about 9. And yeah, you can either get involved on the lower time frame or even simply after this candlestick closes right here. Boom, right? You're waiting for the market to make the first move, right? And that's what I love to see when the market looks like it's going to be moving in one direction and then oop, it just switches, right? So here, you place your stop loss right at this level, get involved, 30-ish pips, 40-ish pips or whatever, right? And you see pretty much the market just took off all the way to 150 pips until the end of that kill zone. Now, I'm a big advocate of taking something off the table or at least targeting some major areas of liquidity and then boom, right? So we saw the market here trade up to about 110 pips before giving any sort of significant retracement on the 5-minute time frame. So every single day I come into the market, I'm paying attention to the London session. The relationship between the London and the New York sessions, very, very important. If the London session is bullish, I prefer to also be bullish as well. But sometimes, depending on the higher time frame, as long as it flows with the higher time frame. And lately with gold, we've been, very, very bullish on the higher time frame, making all-time highs. So it just makes sense to want to stick to that institutional flow. So this is pretty much how I deal with it. Every single day I come into the market, I identify the London high, the London low, pay attention to what happened during those kill zone and see how we're setting up for the New York as well. Here's the takeaway. It's not just about finding setups. It's about trading at the right time of day when liquidity is actually present. If you ignore this, even the best strategy will fail. So when you come into the market, start asking yourself, am I trading during the kill zone or am I trading the noise? Adding this one filter to your trading can literally boost your consistency and allow you to see more profits in the market. Now, if this video was impactful to you, make sure you click that like and subscribe button and share this with a trader that you think needs it. I look forward to seeing you in the next video or in the community. Ladies and gentlemen, I hope you're out there living free. Cheers.